Then the applying for the mortgage loan. Now again, if you've been pre-approved, you've got that process started. But I do want to take a look at the two different types of mortgages that you probably would be looking at. The first one, probably the most common, is what's called a fixed rate mortgage or a conventional mortgage. The rate's going to stay the same for the life of the loan, whether that's 10, 15, or 30 years. And again, primarily 15 and 30 years are what we're looking at. Most common type, with over 90% of mortgages being this way. The great thing about the fixed rate is you lock in for that low rate, and regardless of what interest rates do between now and that 30 years, it's going to stay at that same point for you. The adjustable rate mortgage, or what you'll hear referred to as an ARM, after the initial fixed period, the rate has an opportunity to change. The mortgage company can look at what the current rates are and they can adjust it accordingly. So, as it said in the quiz, and I want to get your opinion on this too, Crystal. In the quiz that we took, it said that if you're going to be in there a short period of time, an ARM might be an okay approach. Would you agree with that?
Most people, if they qualify for a fixed, go that route, especially because, last time a lot of people did ARMs and the economy kind of crashed, and when they thought they weren't going to stay in their house long, then they weren't able to sell it. So, life happens, and even if you think you're going to only be there for a few years, a lot of times it ends up being your forever home. So I guess it's totally up to the buyer, but most people go with the fixed rate.
But at least it gives you an opportunity, an option to take a look at, because the ARM temporarily can give you that lower rate. We were just talking about rates before, and the rates have bumped up a little bit, and then they did come back down just a little bit as well. So we're still, I think, in a pretty good market when it comes to what your interest rates are going to be that you're going to be paying for. But the fixed rate, yeah, that's going to be the one that most people are going to look at. Then there's something called private mortgage insurance, and I mentioned this at the very beginning. If you don't have the 20% to put down, the mortgage lender is probably going to require private mortgage insurance. It's required when you have a conventional loan, make the down payment of less than 20%. You may be able to cancel it once you've accumulated a certain amount of equity. Remember, the equity is the value that you own in the home. So if I buy a house for $200,000 and I put $20,000 down, I immediately have $20,000 of equity in that home. But if I put, again, less than that 20%, when I finally accumulate that 20% of equity, because the house has gone up in value because of payments that I've made, then that private mortgage insurance can be let go. It's not a fun thing to pay, but it's like any other insurance. I mean, anybody like paying car insurance, right? We pay car insurance, pay it, all the time, keeping our fingers crossed that we never ever get into an accident. With this, people don't like it because, again, it feels like you're just throwing that $100 or whatever it is extra from your payment away every single month. But what is it doing? It's allowing you to get into a home. It's allowing you to start making improvements to that home, build up equity in that home, have something that's becoming a financial benefit for you. So in the long run, it's a price that you have to pay, but I think in the long run it's probably worth it. So, but any questions on that? The private mortgage insurance? Okay. And can you give us an estimate of what you're looking at?
It really depends on your credit score, how much you actually do put down, number of borrowers, but, I would say it could be anywhere from $50 to $150 a month.
And then, you can request to have PMI canceled when you hit 20% equity, or otherwise, normally the lender automatically has to remove it at 22%.
Yeah, when it's 78% loan to value. Yeah.
Okay.
So even if you do nothing, when you hit that 78%, it'll automatically cancel, but you can request it off a little earlier.
Right. And what I think is important too to remember is that, a lot of people say, well, boy, when I'm making my payments, all this money is going for interest, so not as much as getting attacked to the principal, so how am I building equity? But remember, market values are changing. When that market value goes up and your house is worth more, that creates equity in your home as well. So it doesn't just have to be money that you're putting into it. When the values go up, you're getting that benefit too.
Right. You would have to get a new appraisal at that point to prove that the value has gone up, but that's something that you can request as the borrower.
Right.